Recently, Warren Buffett's Berkshire Hathaway has made a huge bet, several $billion, on Taiwan Semiconductor. TSM is the ticker. What do they do? What's the upside potential from here? Should you potentially ride along with Warren Buffett? What are some of the key risks with TSM? I'm going to talk about all these aspects and more. If you enjoy educational investment videos, please make a point of hitting that subscribe button. You're watching Unrivaled Investing, so let's dive in to understand what even was Berkshire doing. So they made a $4 billion plus bet in TSM. This makes it a top 10 public equity position. The fact that it's several $billion does make me think that Warren Buffett was involved. This wasn't one of his lieutenant's bets. To understand TSM, they are one of the most advanced and largest contract semiconductor chip manufacturers in the world. Their customers include Apple and fabless semiconductor companies like AMD and NVIDIA. Now, let me explain this sort of bifurcation a bit, because you sort of have how the semiconductor industry evolved. You have these two paths. You have one path, which is, hey, we are going to design the chips, but then we want to rely on someone else to manufacture them, the AMD, NVIDIA sort of aspect of the world. They aren't making the huge capital investment in building out new factories. And these factories can cost tens of billions of dollars. TSM, they're saying, hey, we will build out the latest cutting edge factories. We will own the foundries, the factories that produce these semiconductor chips. You are my customers, AMD, NVIDIA. They are fabless. TSM, one of the largest foundries, the largest foundry in the world, most advanced, most sophisticated. So that's how you should think about sort of how the industry is developed. And you have only a few foundries in the world that really compete with the latest and cutting edge technology. And we'll talk about that in just a second. So if you have Apple saying, hey, we want to have the newest iPhone, the best, Apple's going to design the chip, but they're going to rely on Taiwan Semiconductor to manufacture it because they have the cutting edge factories to actually produce it. Now, what sets TSM apart from other foundries like Samsung or Intel or Global Foundries is their mastery of producing the most cutting edge and smallest chips in the world. Over 50% of TSM's revenues come from the most cutting edge chips, the 5 nanometer and 7 nanometer. This is what's currently in production. You know, you're not looking at other foundries that are producing at scale, let's say 3 nanometer or 2 nanometer. This is the cutting edge, the 5 nanometer in terms of at scale. And you can see how only in the last few quarters, from the third quarter 2020 through now, how the 5 nanometer has become an increasingly relevant and critical part to Taiwan Semiconductor's story in terms of their growth. And you can see how it's now over 50% of their revenue. Now, for context, when you're thinking about nanometers, 5 nanometers, what's that mean? A single human hair is approximately 80,000 to 100,000 nanometers wide. So you're talking about immensely complex technology to be able to, assemble something that's 5 nanometers, 3 nanometers. This isn't a bunch of monkeys, bashing some stones together to try to get some chips out. You can't do this with your hands, folks. Really complex. The reason why smaller semiconductor chips are important is because it implies an increased density of transistors, increased speed, and reduced power consumption relative to, let's say, larger sizes. The 7 nanometer will be more functional than the 10, 5 more functional than the 7. This empowers new markets like smartphones, smartwatches, and cloud computing. Think about, how powerful it is that you can have almost a supercomputer on your wrist or in your pocket. That's the development of continually smaller and more powerful chips. That's what you're talking about here. And when you look at what is TSM's business, 80% is driven by these core markets, smartphones and cloud computing. High performance computing is what they call it. And you can see the growth drivers, smartphone, in the most recent quarter, driving 25% growth, Internet of Things, 33% growth, automotive, 15% growth. So you can see how certain of these categories, which are expected to be secular growers, are growing at nice rates. And these are all things that they're tapping into. The vast majority of the revenue, however, is smartphone and high performance computing. So you can see the cloud and, the cutting edge consumer electronics. That's really what's going to drive their business, at least for now, over, around 80% of their business. Now, what types of challenges? I talked about some of the secular drivers for this business. You want smaller, more powerful, chips. That's the trend we're going into, and they'll continue. And this trend's been going on for several decades. However, Taiwan Semiconductor is the leader. What are the challenges that they face? Because they clearly do have these secular, growth tailwinds as you think about more powerful, phones, more powerful Internet of Things devices all over the place. Thinking about, cloud computing, that's a secular growth tailwind. You look at Amazon, AWS growing like 30% a year. You're looking at this and going, oh, okay, they have these secular tailwinds. What are some of the challenges? Well, part of the challenge is that when you are the factory of choice, the number one player, well, you're also going to be somewhat limited also by your customers. For example, if you look at their top 2 customers, it represents somewhere between 30 and 40% of their revenue, Apple's being a key part of it. And so that does create sort of pushback. If Apple starts having trouble, then you start having trouble, because that's, it's directly tied to how many phones do you sell. And so then you have less demand for producing more, manufacturing more. So as of the most recent year, it was around 36% was the top 2. So you do have some customer concentration aspects. So far, you've seen that TSM has been able to push pricing hikes to Apple and sort of say, hey, who has the leverage? We actually have the leverage, because if you need to get the cutting edge chips manufactured, we are the ones that are going to do it. That is a very strong sign of being in a incredible position. And that's partly because, hey, who else is going to do it? And there aren't really a lot of players that can compete with them, let's say on the 5 nanometer scale. There's Samsung, but by far the vast majority of 5 nanometer chips is being manufactured by TSM. And so this puts the pricing power in their corner. Now, you do have other dynamics of like, well, what about your supply equipment? Most of the suppliers is 2 to 3. You look at ASML, that's one example. That's another one of their suppliers. That's more of a monopoly type of thing. But it is a very tricky, relationship. But overall, I'm looking at TSM as having pricing power over time, as long as they keep launching new powerful new products, if they go into the 3 nanometer and 2 nanometer. So as you see that, and they continue to, move along, let's say the bleeding edge, they should be able to have continued pricing power if they continue to be the dominant player. So far, that seems to be the case. So that sort of deals with the customer concentration risk, which will be lumpy. If Apple all of a sudden starts having trouble, that will impact TSM's growth. Another key aspect is geopolitical. It's been very clear that China wants to retake either Taiwan, either passively or aggressively. We will see how that plays out. This is a hot point for the world, because if you have TSM, which is in Taiwan, and most of their factories are in Taiwan, compromised because China takes over, then what about the defense industry around the world needing to get their chips? And could they all of a sudden become impaired? So that is part of the reason why you have thoughts of like, oh, okay, well, the US needs to make investments in Intel to encourage them to make new cutting edge chips in the US. But so far, Intel is well behind when it comes to coming out with the latest cutting edge technology. Now, TSM is looking to, make investments in the US, but you're looking at chips that are generally designed, you're looking at not the cutting edge stuff. You're not looking at the 3 nanometers or 5 nanometers. You're looking at much bigger chips. So that is a key aspect to consider, is the geopolitics of what happens if China looks to get involved. Another key aspect is capital intensity. This is not the types of free cash flow machine that you see with a company that is not capital intensive. This is a company that has to make huge amounts in terms of investments into new factories, into new R&D, to sort of say, hey, how are we going to build out this next design? Where are we going to go how are we going to go from 5 to 3 to 2 to 1 in the future? How are we going to do this? And that requires tons of cash that goes back into the business. So whenever you're looking at their net income, the reality is that isn't really the free cash flow that can go back to you as a shareholder. Probably about half or a third gets actually returned to shareholders via dividend. The rest of it goes back into building new factories, new facilities in the business that, hey, that's the next 3 nanometer, that's the 5 nanometer. So those are the key challenges that investors should understand. This is quite unlike some of Berkshire's other investments that are not capital intensive, where, You look at a company like Moody's, another, or Coca-Cola, where it's not as capital intensive. It's more about a brand, and you can return nearly all their net income as free cash flow to shareholders. And that's very attractive over time. So those are some of the three key points that I think about when it comes to TSM, some of their challenges. Now, investing all this money back into the business is really because there's an opportunity to. In the 2021 annual report, management was talking about how they're looking out over the next few years as a period of higher structural growth, looking at multi-year megatrends of 5G and high-performance computing-related applications expected to fuel massive demand for computing power. So as you think about the latest cutting edge, let's say AI, an AI chatbot, and you're going to say, hey, I'm going to want that on all my devices, or I'm going to want that, easily accessible. That's going to need to get powered by the most cutting edge chip. It's going to require more and more compute power. And so as you think about the demand for compute going up over time, that means more demand for the cutting edge chips from TSM. So that should be an opportunity for the ones who have the lion's share of the market in terms of the best chips that are out there. And looking at their growth in 2022, you're looking at 44% growth year to date. They haven't reported December yet. That should be coming out next week in terms of their total growth. And, so hyper growth in most recently in 2022. They recently talked about at the end of the year how, yes, they were doing well, but they were also looking to expand their facilities. Now looking at 3 nanometers in a park in Taiwan, Southern Taiwan Science Park. Their Fab 18 facility has a clean room area of 58,000 square meters. They're talking about an investment of 1.86 trillion new Taiwanese dollars, which is the equivalent of $60 billion. So it gives you perspective. These are huge investments, creating tens of thousands of jobs, 24,000 jobs. This is 24,000 construction jobs, over 11,000 high-tech direct jobs. So these are huge projects. And by the way, not only are they rolling out the 3 nanometer, but they're also planning on starting to make preparations for the 2 nanometer. So whatever success you're seeing now, they're saying, hey, we want to keep investing. Only the paranoid survive. Let's keep investing because we need to make sure we have the cutting edge chips, not only now, but in the years ahead, because we don't want someone else to leapfrog us. And then all of a sudden we do start having pricing pressure. So that is a core aspect to understand with this business model, is that free cash flow can't go to you as a shareholder, because otherwise you start losing pricing power because you no longer have the cutting edge chip 3-5 years from now, 10 years from now. And that's really where a lot of these companies, that's how companies are valued, is you're thinking about 5-10 years out from a business perspective. So that's really important to understand, that they have huge investments ahead of them, 60 billion just with this new facility for the 3 nanometer. So where does Taiwan Semiconductor stock go from here? First, if you're looking to take charge of your investment journey, consider unrivaledinvesting.com for compelling investment ideas, real-time portfolio updates, and our exclusive Discord server available for annual subscribers. Also recently launched 2 new investment courses for investors looking to learn how to read financial statements as well as to size up valuations. Is a stock price a promising or perilous price? I talk about that in my valuation course. In full disclosure, this is not financial advice, talking about TSM. Looking at the stock past year, down at one point more than 50%. Warren Buffett was buying it during this period, during the third quarter. And so you see that price is roughly around where he was buying it. It's up a little bit since then, but still over the past year down nearly 40%. Over a decade perspective, however, it's been a very great performer, up between 400-500%. During the COVID bubble times, you're talking about closer to 700-900% over a past 10-year perspective, but still exceptional returns and long-term grower looking at this over a multi-year perspective. So what's holding the stock back? Why is it down this past year? Well, part of it's the concerns of, as I mentioned earlier, if iPhone, if Apple sneezes, do you have a cold with TSM is sort of the concern. And, if you have Apple starting to say, hey, we're having pressure, expecting orders to drop on weak tech demand, what does that mean for TSM? Does that also mean lower margins potentially? And then you also get the Wall Street bandwagon, sort of an amplifying engine saying, oh my goodness, TSM is not immune to the industry inventory digestion and end demand correction into 2023. So talking about potential recession that's going to hurt, their results, and there won't be as much demand, and maybe growth drops significantly, maybe even declines. You get Wall Street amplifying the current concerns. And I look at this, and this is classic Warren Buffett, in my opinion, where he's looking at whatever Wall Street's nervous about and saying, hey, I'm arbitraging the time. I'm focused on 5-10 years from now. You're focused on the next year. And Warren Buffett wants to say, hey, I want to own things that he has high conviction will be worth more. The business fundamentally will be worth more 5 years from now. And he wants to pay a fair value for it. And so I think that's why TSM checks those boxes, because Wall Street's concerned about the next year or two. How cheap can it get? They have to tell their clients, oh, avoid this thing if it's going to fall too low. He's saying, hey, I can just keep, generating 30, 40 billion free cash flow a year. He can, or 50 billion free cash flow a year. He can redeploy that into TSM, leverage, legging into it over time, even as the stock price drops. Now, another core aspect that investors will need to consider is the margins on TSM have been, I'd say, a tad volatile. At one point, sub 35%, now closer to 50% profit margins. Will that, let's say, normalize in the 40 to 45% range in a less hot economy? Let's say, Apple does start having challenges selling the latest cutting edge phones. Does that mean you also see profit margins drop to, let's say, 40 to 35%? For my purposes, in terms of the assumptions, as long as they continue to make the cutting edge chips and have the lion's share of those markets, I think they will be able to maintain very high profit margins. So I'm assuming 40 to 45%, but that is a key risk into the thesis. Looking at TSM stock, around $78 per share, $400 billion US stock price. That implies around a 12 trillion new Taiwanese dollar market cap when you look at the conversion rate. So looking at the business currently trading around 13 to 15 times earnings, depending on how you think about their margins. What do you think is their long-term margins? I'm using a rate somewhere between 40 and 45% margins. So far, year to date through November of 2022, they were growing around 40-45%. So that's the rate I'm penciling in. We just don't have 1 month of data. So arguably very reasonably priced for a business growing at 40-50% this year, or 2022, I should say, to be only valued at a teens multiple. The question is, what's the growth rate over the next few years if you potentially have a recession, if Apple starts struggling or isn't selling as many phones, the consumer starts struggling. So I put in a range of 7 to 14% in the years ahead. We will see. Maybe that's too high, maybe that's too low. But the reason why I think this is interesting, at least on the low side, is if you assume only 7% growth and you give no credit to valuation expansion, you say the valuation multiple stays the same, around 15 times, and they continue to pay out around a 2.5% dividend, which is approximately around where they currently are today, then given the fact that you're getting, let's say, 7% growth, keep in mind last year 18% growth, the year before that 25%, this year closer to 40-50%, if you're only assuming 7% growth over the next 5 years, plus that dividend, your shareholders could get around a 9% return. And I'd say this is pretty reasonable, pretty conservative assumptions. And so I understand why Warren Buffett got excited about it, is he's saying, hey, I can comfortably pencil out, let's say, a 9% return. Whereas if they execute and things really work out well from a macro perspective, let's say they're growing closer to 14% and their margins stay high around 45%, then you're looking at a situation where the stock price could be closer to 200% upside over the next 5 years, assuming a little bit of multiple expansion as well. Once again, this is a hypothetical valuation framework. A lot depends on the execution. If the execution is way worse than this, I'd expect the stock price to be a lot lower. If they do better, it wouldn't surprise me to see the stock price higher. But this clearly speaks to me as a value investor setup, because, assuming some conservative assumptions for one of the world's best companies, you can pencil out 9-10% a year over the next 5 years. And assuming, things work out, you're penciling out somewhere between 20 and 30%. So that gets me very excited. I personally want to look at this more, think about it more from my personal investment journey as I look at the current climate and think about, hey, we're potentially facing a recession. We're potentially facing much lower stock prices because, interest rates have moved up. Cash is currently yielding 3.8%. You can go to Interactive Brokers, link below. That's where they're paying 3.8% plus on cash balances. So I look at this and I'm thinking it's a tougher environment for stocks. It wouldn't surprise me to see share prices generally a lot lower, especially if we have a recession. That would hurt TSM. So I personally, as I look at investments, I want to find things that are a little bit more asymmetric. I might consider TSM in the future. Personally, I just called out to my subscribers at Unrivaled Investing, that I was buying a company trading below liquidation value, because I said, wow, it's trading around cash. It's below liquidation value. If certain catalysts come to play, this could be worth several 100% upside from here. So that's the type of thing that I want to own in this environment, where I'm saying, hey, there's this increased uncertainty because you have this recessionary pressure of like, hey, if there's a recession, is it possible TSM's margins look completely different? Well, if you're buying a company below liquidation value that has several 100% upside, that's less of a concern thinking about, hey, there might be a recession, because you're like, hey, you're already below liquidation value. Is it going to get much, much cheaper? Maybe, but that's the type of asymmetry I want to find in my own personal investments. Once again, I call those out at my subscribers at unrivaledinvesting.com. If you enjoyed this video talking about TSM, Taiwan Semiconductor, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for watching Unrivaled Investing.